Assalamu alaikum, my honorable teacher. At the beginning of my presentation, I would like to introduce myself, Mishkaful Islam. The last three digit of my student's ID known is 163 actually. So first of all, I'll introduce about my agendas actually. So first one, I'll tell about provide a summary of the monetary policy, and next I'll tell about the mentioned significant changes compared to the last policy actually. And another one is what are the tools used by Bangladesh Bank. And finally, I will tell about shortly the suggest the policy reforms needed for your understanding actually. So let's get started. So, first of all, we have to know the monetary policy. So, what is monetary policy? So, actually, monetary policy is the process by which a country's central bank, in the perspective of Bangladesh, like the Bangladesh Bank, manages the money supply, credit, and the interest rate in the economy to achieve the specific goals. Actually, now, moving forward to my next last slide is the last monetary policy of Bangladesh Bank actually. So, the last monetary policy of Bangladesh Bank that's called with the policy report. So, first of all, we have to know the repo rate. So, the policy report, the interest rate at which the central bank lends money to commercial banks for short-term liquidity support. That's the main tool of monetary policy. And actually, the policy repo rate is that remains 10%, that unchanged for the first half of 2015 to 2016 actually, so July to December 2015. And another monetary policy by Bangladesh Bank is standing lending facility, that short form is SLF rate actually. So the SLF, that means the rate at which banks can borrow overnight from the central bank against approved collateral. It acts as a safety valve to meet short-term liquidity needs. So the last monetary policy of standing lending facilities that held at 11.5%, and another one is standing deposit facility. So another standing deposit facility, the rate at which the bank can park excess funds overnight with the central bank, helps absorb surplus liquidity, and that affects the reduce by 50% basis and points that mid July to 8% effective from actually 15 January 2025 actually. And now our last um, point is the private credit growth target. So that may be the central bank sets a target for the growth of credit to the private sector to ensure balanced economic expansion and control inflation. So that's rate is 7.2% from the previous was 9.8% to slow lending and control inflation. So another one is the significant change compared for the last policy actually. So I'll actually already tell about what is the repo rate, what is the private sector credit target, and SDF rate and SLF rate actually. So now that show this slide actually the significant changes here. And actually now my next slide is the tools used by Bangladesh Bank to control the inflation actually. So first tool is the repo rate. So actually the repo rate at which the central bank lends to commercial bank, actually this high repo rate, this high repo rate to tight the money, and in contrast that affects the actually opposite effect to the repo rate actually. So the reserve repo rate, and actually so reserve repo rate actually so at rate at which central bank borrow from banks, higher repo rate that absorb liquidity, lower reverse repo rate that inject liquidity actually. And another one is the policy rate. So the policy rate, the key benchmark rate guiding overall monetary policy, often same as the repo rate actually. And actually, so the cash reserve requirement, short form is the CRR actually. So deposit banks must keep with central banks. Actually, the higher CRR or cash reserve ratio, that less money to lend, at our lower cash reserve ratio, that can be the more liquidity. to control inflation by Bangladesh Bank. The statutory liquidity ratio that the percentage deposit bank must invest in approved securities control credit follow by Bangladesh Bank. And moving forward to our next slide. So that's going to be the standing lending facility that I have already told you. Uh, mm, the bank's deposit access fund, the central bank overnight. That's the standing deposit facilities. And the open market operation, the central bank buy or sell government securities to inject or absorb liquidity, right, to control inflation. And the bank rate, at which rate the central bank lends to the commercial bank in the short form and without collateral. That's going to be the bank rate. So and last of all is the foreign exchange intervention. So the foreign exchange intervention actually. So buying and selling foreign currency to stabilize the exchange rate and control money supply. And so actually all of these tools are used to control liquidity, credit and inflation, keeping the economic stability. So actually now moving forward to my next slide is that is the suggestion, the policy reforms actually. So first one is the exchange transmission mechanism. So further promote digital banking and transparent interbank market to spend rate change to the real economy. Now another one is the strengthen FX reserve build-up, developing hedging framework and improve export competitiveness to reduce the dependency on external borrowing. And another one is the deepen financial sector resilience. So that is the ramped up macro prudential oversight, address non-performing loans and boost capital adequacy, aligning with financial stability assessments. And another one is and the last one is the actually augment structural reform continues. So that is the liberalizing interest and exchange rate regime, simplify bank consolidation and governance framework to attract investment and strengthen banking efficiency. So that's all of my side. Thank you, sir.